What do you think happened?
Well, there was a few things. First, there were obvious stop losses going off at 1550, and we're looking at the 1525 range. There were a lot of sellers out there. Momentum investors have dominated the trade, and a lot of this had to do with, first off, some of the analyst downgrades, but also concerns about Cyprus. When you have momentum investors piled into a trade to the extent that they are, you're going to get capitulation like we're having now, and this is really a continuation or a culmination of what we've seen really since November. We've seen massive volatility driven by the momentum investors, not much focus on fundamentals necessarily, because the fundamentals still look strong, but gold has become a very different asset, and there's a very different owner in it.
So Alan, when you're looking at this market here, is gold going to find support around 1500, or do we have more room to fall?
Well, I think this was a break in the dam. When we broke that 1550, that was the breakout area on the upside. If you look at it back in July of 2011, it found that as support 3 times over the last couple of years. And then here recently, it had been trading in a $80 range between 1620 and 1550 or so. And that targets 1480 on the downside. So there could be some more downside pressure. But as a trader, I look at this as a longer-term opportunity here on oversold conditions. Using options, I can position for some recovery bounce. We want to put it in perspective. Gold, it was at 1,700 just here in January, so we're down 12% straight down, and the dollar looks like it may have started topping out. Last week it made new highs and then closed lower on a weekly basis, so that could help gold in the long run if you can get through this capitulation and be there when it does recover.
So Alan, what would be your option call then if you're going to think that perhaps gold can find some support later in the year?
Well, a December call spread gives us about 7 months of time. A 1550, 1600 call spread has a maximum spread potential of $5,000. It'll cost less than $2,000 at this particular time. So that's why I want to. That's how I want to position for a gentle bottom, have some staying power, as opposed to trading GLD or trading gold futures. Where do you put in your stop? This thing's going to be everywhere. Use options. You have limited risk, and be there for the long term.
Jeff, do you think the shakeout's done, or do we think we're going to see more bulk selling?
No, it's crucial how it acts here at 1500, because we have more orders at 1500. If we do break under 1500, we will see another leg down. If we stabilize here, I anticipate we'll see a relatively moderate recovery. It really depends on some of the fundamentals coming out of the ECB, and also to look at these institutions. These institutions have a whole other agenda when it comes to buying and selling gold, and to the extent that they continue to use this momentum to their favor, the regular investors have to be very cautious.
Jeff, where is the money going when you see most assets down today?
It's hard to say. I mean, I think there's a lot of cross currents right now that these rotations are very difficult to interpret. What I see is that you're seeing pressure on the commodities, but obviously with the consumer number, the PPI number, there is concerns that we are re-entering a further leg of this economic downturn. So assets are just going from one asset to another without any real method to it.
So Alan, when you're looking at the whole commodity complex today, do you think that gold has the continued power to drag down oil and copper and nickel here?
Well, sometimes gold trades very emotionally. In the big picture, if you look at gold, it's been trading between 1,800 and 1,600 roughly for the last year and a half. Now we've broken to the downside of that. So markets often come back to the breakout point. Look for it to recover, come back to 1,600. That's not unreasonable. That's not expensive. I think people are going to find some value here. But if you look at the CRB has been really getting hit hard. It's down 20%. The commodity basket itself is down 20% from 2011. So it hasn't participated in this asset reflation like we've seen in equities, and like your guest alluded to there, money isn't lost, it just moves. Unfortunately, it hasn't moved into commodities nearly as fast as it's moved into equities, and it supported that marketplace.